The rules for taxing interest on Provident Fund. The government has notified the rules for taxing the interest earned on Provident Fund contributions beyond a limit. What is the limit? How much will the tax be? And what is the objective of the move? Following its budget announcement in February, the Finance Minister has now notified the rules for taxing interest income on contributions made to the Employees Provident Fund beyond rupees 2.5 lakh for private sector employees and 5 lakh for government sector employees. Beginning this fiscal, the government will tax interest on contributions made in excess of these limits with separate accounts to be maintained within the Provident Fund account for 2021-22 and subsequently years for taxable contribution and non-taxable contribution made by an individual. What is the tax on EPF contribution? In February, the budget proposed that tax exemption will not be available on interest income on PF contribution exceeding rupees 2.5 lakh in a year. Although this has been a concern for salaried individuals contributing to EPF, it will impact only those who contribute more than 2.5 lakh in a year, and it will not affect their existing corpus or the aggregate annual interest on that. In March, the government introduced an amendment to the Finance Bill 2021 in which it proposed to double the cap on contribution from 2.5 lakh to 5 lakh for tax exempt interest income if the contribution is made to a fund where there is no contribution by the employer. With this, the government provided relief for contribution made to the Central Provident Fund that is available only to government employees and there is no contribution by the employer. What are the rules to enable this taxation? The rules were notified by the Finance Ministry on August 31 in an amendment to the Income Tax Rules 1962 that will come into effect from April 1, 2022. The Central Board of Direct Taxes has inserted Rule 9D according to which income through interest accrued during the previous year that is not exempt over rupees 2.5 lakh for private and 5 lakh for government employees shall be compound as the interest accrued during the previous year in the taxable contribution account. Separate accounts within the Provident Fund account shall be maintained during 2021-22 and subsequent years for an individual taxable contribution and non-taxable contribution. The EPFO, however, is yet to formalize the separation of taxable and non-taxable contribution in their accounts. Some EPF board members said the tax to separate the account for such contributions will take time. Data will need to be aggregated and then separate accounting process has to be determined. For such account details are yet to be finalized. The CPDD has stated that the closing balance of March 31, 2021 and the interest accrual on it will be treated as non-taxable component. The taxable contribution account will consist of contributions made by the individual in the account during the previous year and subsequent years in excess of the threshold limit. Why is the proposal? The budget proposal has noted the government has found instances where some employees are contributing huge amounts to these funds and are getting the benefit of tax exemption at all stages: contribution, interest, accumulation and withdrawal, with an aim to exclude high net worth individuals from the benefit of high tax-free interest income on their large contribution. The government has proposed to impose a threshold limit for tax exemption. This will be applicable for all contributions beginning April 1, 2021. This fund is actually for the benefit of the workers and workers are not going to be affected by it, Finance Minister Nirmala Sitaraman had said while presenting the budget in February. It is only for big ticket money which comes into it because it tax benefits and also accrued 8% return. How you find huge amounts, some to the extent of 1 crore also being put into this each month. For somebody who puts 1 crore into this fund each month, what should be his salary? So for him to give both tax concessions and also an assured 8% return, we thought this is probably not comparable with an employee with about rupees 2 lakh. How will it get taxed? For an individual in the higher tax bracket, 30% of the interest income on contribution above rupees 2.5 lakh would get taxed at the same marginal tax rate. What this means is that if an individual contribution rupees 3 lakh every year to the Provident Fund, including the voluntary Provident Fund contribution, then the interest on his contribution above rupees 2.5 lakh, that is 50,000, will be taxed. So the interest income of rupees 4 8,250, 8.5% on 50,000 will be taxed at the marginal rate. If the individual falls in the 30% tax bracket, he or she will have to pay tax on rupees 1325. For an individual contributing rupees 12 lakh in a year, the tax will be applicable on interest income of rupees 9.5 lakh. 12 lakh minus 2.5 lakh. In this case, the tax liability would amount to rupees 25,200. Will it get taxed for perpetuity? As per the notification, the interest income on additional contribution over rupees 2.5 lakh for private and 5 lakh for government employees for a year will get taxed every year. This means that if your annual contribution to PF is in financial year 22 is rupees 10 lakh, the interest income on rupees 7.5 lakh will get taxed not only for financial year 22 but also for all subsequent years. If the PF contribution is the same for financial year 23, the tax will have be paid on interest income of rupees 15 lakh. If you earned interest of 8.5% last year, if you fall in the highest tax bracket, then the following year you will earn effectively around a 5.85% on additional contribution, assuming the interest rate is unchanged. Thank you.